Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings to reveal the juicy and sometimes not so juicy truths behind those big company announcements. Today we're looking at Lindsay Corporation's latest report, and let's just say they're making some interesting moves with their own stock. Get ready, because we're about to decode what a new share buyback program really means for you as an investor and for the company's future. So, what is the big news from Lindsay? Well, on the 3rd of November 2025, their board of directors gave the thumbs up to a brand new share repurchase program. This isn't just a small thing either. They're planning to buy back up to a whopping $150 million of their own common stock. Now, this comes right after they finished up a previous buyback program that was even bigger. A $250 million one. What does it mean when a company decides to buy back its own stock? Essentially, it is like the company is saying, we think our stock is a good investment right now, and we want to put our money into it. They can do this in a few ways. They can buy shares on the open market when people are selling them at the current price, or they might make deals to buy larger chunks of stock. They're also planning to use something called Rule 10b-5 to 1 trading plans, which are basically pre-arranged plans for buying back stock. This buyback program allows them to purchase their common stock, which you can find traded on the New York Stock Exchange under the ticker symbol LNN. The company hasn't set a deadline for this new buyback program, so it can go on indefinitely. Management will be the ones making the decisions on when, how much, and how they buy back these shares. They'll be looking at things like how the stock is trading, what is happening in the market, and with their business, and of course what the rules say. It is important to remember that this program doesn't force them to buy any specific amount of stock, and they can pause or stop it anytime they want. Now, there is a bit of a catch here thanks to something called the Inflation Reduction Act. If the amount of stock they buy back is more than the stock they issue, they'll have to pay a 1% excise tax on those repurchases. This is something companies have to be mindful of in their financial strategies. This whole announcement is part of what is called a Regulation FD disclosure. This basically means they're making sure important information like this share buyback plan is shared with everyone at the same time, so no one has an unfair advantage. They've also attached a press release about this new program, and we're told to consider that part of this disclosure. So, Lindsay Corporation has authorized a massive new share buyback program. What does this really tell us? On the surface, it signals confidence from the company's leadership. They believe their stock is undervalued, or at least a sound investment for their own capital. Buying back stock can have a few effects. It can reduce the number of shares outstanding, which can boost earnings. Per share, making the company look more profitable on a per share basis. It can also signal to the market that the company has strong cash flow and is returning value to shareholders. This is often seen as a positive move by investors. However, you always have to look a little deeper. Is this the best use of the company's cash? Could that $150 million be better spent on research and development? Expanding their business, acquiring other companies, or even just paying down debt. When a company buys back a lot of stock, it can sometimes be a way to artificially inflate the stock price or boost earnings per share without actually improving the underlying business operations. We need to consider the context of their previous buyback program, the size of this new one, and their overall financial health. The fact that they just finished a $250 million program and are immediately launching another $150 million one suggests they are generating significant free cash flow and are committed to returning capital to shareholders. This is generally good news, but we'll need to watch how this impacts their cash reserves and their ability to invest in future growth. It is a delicate balance for any company to strike. Now, looking at this report, no major financial tables are detailed within this specific filing document itself, which means the core of this news is the announcement of the share repurchase program. The filing is more of a notification of a significant corporate action rather than a deep dive into their quarterly financials. We're told that a press release is attached as an exhibit, and that is where more of the narrative surrounding this decision would likely be. But let's think about Lindsay Corporation. They're known for their irrigation and equipment solutions, serving agricultural and infrastructure markets. In a competitive landscape where agricultural technology is constantly evolving, a strong share buyback program can be a sign of maturity and a focus on shareholder returns. It might also suggest that they don't see immediate, large-scale acquisition or investment opportunities that would require that cash pile right now. This move could also be influenced by market conditions and the broader economic outlook. Companies often adjust their capital allocation strategies based on interest rates, inflation, and sector-specific trends. A large buyback program can be a signal of management confidence in navigating these conditions. However, we must also consider the 1% excise tax. While seemingly small for a program of this size, it represents a notable cost that impacts the net amount of capital being deployed. It is a cost of doing business in the current regulatory environment. Overall, Lindsay's decision to launch a substantial new share repurchase program immediately following the completion of another large one indicates a strong commitment to returning value to shareholders. It is a strategic choice that can boost metrics like earnings, per S-hair, and return capital to investors who might be looking for income or capital appreciation. However, it is crucial for investors to weigh this against the company's long-term growth prospects and other potential uses for that capital. So, what is my take on Lindsay's latest move? It is a clear signal of confidence and a commitment to shareholder returns. The large scale of the buyback suggests they have a healthy cash flow and believe in the value of their own stock. This can be a positive for existing shareholders by potentially increasing the value of their shares. However, the absence of a specific expiration date and the reliance on management discretion means the actual impact will depend on their execution. It's important to remember that while buybacks can be beneficial, they aren't a magic bullet for long-term success. The company still needs to innovate, grow its core business, and manage its operational challenges effectively. The excise tax is a notable, albeit small, drag on the effectiveness of the program. What are your thoughts on Lindsay's new share repurchase program? Do you see it as a sign of strength or a missed opportunity for growth? Let me know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe to Corporate Decoder for more in-depth analysis like this. And don't forget to join our Discord community, linked in the description for more exclusive content and discussions. Thanks for watching, and I'll see you in the next one.